Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been America's foremost precious metals brokerage firm since 1972, helping you build a strategic precious metals portfolio. Call 800-525-9556 to buy gold, silver, platinum, or palladium today, or go to McIlvaney.com. Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets as well as other markets related to the metals and how they impact each other. And that's been a perfect segue into this week because there's been volatility across all market sectors. And Robert's sitting here smirking like almost too much to cover in one brief little metals show. So, Robert, why don't you kick us off? What's your strong takeaway of the last 5 business days?
Gold popped up last week in the middle of the week, Wednesday, when we recorded last week's show, above 1840 and chopped around there. Today on the Fed news, gold's pulling back, basically back down to where it started last week. So we've had a pop up, traded sideways, pop back down. But the good thing to note there is that gold has been clearly holding firm well above the last 4 previous lows and looks like it's starting to gain traction. And silver has been acting similarly. It's been a little weaker here, bouncing around, but the volatility in the markets are really a lot of noise with the equities market. Equities market sell-off has been driving the dollar up a little bit. And so gold's trading really well here. I like it.
So you just mentioned a few other markets as well. We'll get into equities. We'll get into the dollar. But Miles, what are you seeing from a technical chart analysis standpoint?
Yeah, Robert's definitely right. We've had pretty significant growth in gold just going back to like the middle of December, 1750 up to a high of around 1850, $100 move in a month with some very clear stair steps up. Now, I love the fact that the day before the Fed announcement, it's almost like these things always work out the exact same way every time we talk about charts. The day before the Fed announcement, gold came into the declining top end of this triangle correction pattern we've been looking at for the last year and a half. Lo and behold, Powell comes out, discusses once again potentially raising interest rates, potentially decreasing and phasing out asset purchasing, and an expectation of a stronger dollar and possibly a weaker economy. Gold takes a nice decline. Now, you can blame the decline today on Powell, or you can blame the decline today on traders, seeing the top end of that trading channel. But even with the decline today, which was pretty significant, about $35 in gold, we're still at a higher low.
So far.
Yeah, have we bottomed yet? We'll see.
So I'm very much liking the gold chart, where the fib levels are, which you can see on the chart here, and where we came into. If it turns around and continues up tomorrow, that's incredibly bullish. The fact that this is all we get and we've yet to see any kind of turnaround going really all the way back to August.
I totally agree.
Yeah, a floor in August, October, December, January. We've just been marching up and up and up in gold from the bottom end to the top end of the trading range, and I would love to see the big B word show up, breakout.
Last year, we saw record outflows out of ETFs in a single year. Record, think about that. And the spot price still was able to stay above $1,800. Well, now you're seeing money move the opposite direction. You've got huge money moving into gold. In fact, into ETFs. Last Friday was the record inflow in a single day since GLD, the ETF, has been in existence. So there's definitely a mindset shift, and the charts that you're showing here are reflecting that. What about silver? Is it keeping pace?
Silver's about halfway between the low end and the top end, so no. Technically not, or at least not yet. Although silver's range is substantially larger, about a $5 range up and down. Silver did have a little bit of a drop today, but it was already on the way back down, so that's not surprising at all. I'd like to see silver stay above maybe 23. We're at about 23.5 now. That would be very bullish, but really anything above 21.50 also remains bullish. So the range is bigger in silver because silver is the more volatile metal, but I do like the way it's climbing, and I actually would expect, regardless of the Fed announcement today, expect to see silver continue to climb up like gold did and test the top end of that range.
Yeah, eventually silver is going to match what gold's been doing and staying bullish. And once it starts to confirm the move higher and both metals are in tandem, prices are going to go higher. I think silver, once it gets a little bit steam behind it, will be up in the $28, $30 range pretty soon. Because, I mean, that's what you're paying for real silver anyway these days, with premiums the way they are.
It's such a good point. I mean, we have to be sensitive to that when we're educating and advising our clients on what exact product to get in. It's one thing for the price to be low on the futures market spot price. It's another for supply to match the demand and keep the premiums down, and we're just not seeing that. The request for silver is far outpacing the supply in the markets, much like what we're seeing around the country with the supply chain disruption. We don't have necessarily a disruption in supply. It's just a matter of supply and demand fundamentals driving premiums higher. So we have to get creative. We've got to be advising you on the best way to acquire those ounces because, Robert, you're totally right. You're not going to find it at $23 an ounce. It just can't be found.
Yeah, and wait until a manufacturer of electronics decides that they need to stock up on one of their materials that they use in their electronic systems. Just wait until they decide, we better stock up on silver because we use it in just about everything we make. Look at the commodity prices with other commodities and some of the hoarding that's gone on there. I mean, just wait until you have a big industrial player decide they need to stockpile silver.
Or platinum. I mean, we're going to see that same sort of thing with the automotive industry potentially, right?
Yep. Because, the point there is that those two metals, the white metals, have a lot of demand from the industrial sector. So just wait until that happens because it's coming and silver will be moving a lot higher quicker than gold. That's where we look for the ratio trades.
Well, while we're talking about demand, what about supply? I mean, with the geopolitical issues taking place in Russia, Ukraine, and the majority of the world's supply, or at least a very large percentage of the world's supply of things like platinum and palladium coming out of Russia. Look what palladium price has done. It's up like $400 or $500 over the last couple weeks.
That's right.
So it's not just demand, it's also supply.
Absolutely. So show us those charts, and then let's jump into the dollar, too.
Sure. Well, you can see platinum. I put a chart up last week expecting, or at least hoping for, a stair-step pattern up, which is exceeding the November highs at around 1100, maybe stair-stepping to 1150, 1160, coming back down and then launching up from there. Platinum actually hasn't really gone up or down over the last few days. We had a big jump up in platinum back on the 19th, so a week ago today, last Wednesday, and hasn't really had the move this week that we've seen in gold and silver and the sister metal palladium. Now you look at palladium, significant stockpiles coming out of Russia. No surprise that since the 18th, so about 8 days ago, palladium has gone from 1860 up to about 2340. So a significant move up in palladium. So there's the supply side. Supply side economics, demand side economics, it's all part of the same puzzle.
So supply side being up a little bit, you guys think, in the U.S. dollar? What are you thinking there? Let's talk about that chart because, I don't see the supply side dwindling.
The dollar came down to the 50% retracement line here about 2 weeks ago. We talked about this last week and has been up since then. So from about 94.58, currently we're at about 96.50. So up about 2 points on the dollar, right? Still sitting just above the 618 correction zone. So still bearish on the dollar. Looks like we're just in a bullish correction within a bearish trend. Dollar's been up since last January, so it's been rising for the last year. But ultimately, we're still coming off a high of around 103 back in March 2020. So dollar would have a long way to go just to get back to where it was. Now, maybe interest rates hikes help, but we'll see how interest rate plus inflation goes going forward.
Yeah, you mentioned that high in 2020. If you take the high in 2020 down to the low in early 2021, the dollar hasn't gotten back up to that 618 retracement back up. I think somewhere in the mid 97s would be where it would actually touch that 618 retracement. Miles will put it on the chart here. So it is possible, I guess, if you have a Fibonacci 618 retracement on a long-term basis, the dollar could potentially put in a slightly higher high to finish that 618 correction back up to mid 97s before it actually rolls over. So that wouldn't be surprising considering the dollar starting to move back into the range where it was for a couple months. So we'll see. Ultimately, we think the dollar's headed a lot lower for obvious reasons.
Right, and I completely agree. I mean, that mid to high 97 range, that's kind of the last breath of air, the last attempt the dollar made to continue rising. This would have been about June of 2020.
Right.
Before it eventually fell off the edge and dropped another, almost 8 points. So, yeah, I think that would be a fantastic place to look at the dollar climbing back up to. I'm in complete agreement.
So let's pivot over to the equities markets because that's where a ton of volatility
Do we
has
dare?
been witnessed. Do we dare? I mean, yeah, there's way too much to talk about. And we still have to talk about the Federal Reserve announcement today as it relates to the metals. But with the equities markets, this is essentially unprecedented type of reversal activity. Although we have had a total of 6 days, get this, the NASDAQ has had 6 days in which it reversed a 4% drop or more, only to end up closing in positive territory. So down 4% on the day to finish the same day in positive territory. We've only seen this action before in bear markets. October of 97, October of 2000, July of 02, October and November of 2008 with the great financial crisis. And then now we have it again here as of January 24th of 2021, where there's no doubt that this continuation of the bearish trend in those markets is going to continue. And suddenly you get this huge influx in a very short period of time to close positive. So that to me reeks of manipulation, not a free market necessarily. But we said 2 weeks ago that the equities markets hate deleveraging. We're looking at the impact of that deleveraging, and the markets are talking to the Federal Reserve about just how sensitive they are to the policies they're planning.
Yeah, something I wanted to bring into this conversation on the equities market, maybe the best way to describe it would be a lot of people put their portfolios somewhat on autopilot, whether they have a money manager or they just have an automatic contribution to their 401ks and they automatically are invested in these funds. You know, not many people pay attention to the markets every single day or week. A lot of people in America just autopilot. Here's my money, put it in the market, diversify across a bunch of stocks. Well, if you look at the S&P, the action with the Santa rally right there at the end of the year had a big rally and finished the year really strongly. And I think, you know, what the S&P closed the year like 29-30% total year-end return. So somebody on autopilot gets a statement at the end of the year and they see this great number, like 29-30% or whatever, underperform, overperform that. That's a great year in the market or anywhere. And then since the first of the year, we've had 3.5 weeks of total disaster, total liquidations of institutional money coming out of it. And I kind of polled a few people that I saw around town in the last couple of weeks. I'm like, did you know that the market's, you know, down and pretty much turning into a bear market? People on autopilot have no idea. They just look at their end of the year statement and they have no idea that the market's essentially falling apart in 3 weeks. And if the trend with the first week of trading of a year is very indicative of what happens for the rest of the year, if that plays true, we're going to have a really ugly year in the equities market. And unfortunately for those people in autopilot, the market goes down a whole heck of a lot faster than it goes up. We're at a very crucial point with the markets, with people on autopilot not really paying attention. I bet people have not even stepped aside. They just autopilot, let their funds run into the stock market. And that could be a very painful decision or lack of decision going forward in the next 10 months.
I totally agree. And that's why the easy money has to remain. They have taken the stance that they're going to bolster the markets. It's not bolstering the unemployed. It's not bolstering Joe and Jane Smith in their personal situation. It's bolstering the markets. And Powell even said today in the interview after the release of the FOMC minutes, the volatility we have seen this month will likely continue, so use extreme caution. So to start that quote, he actually said that they expect the bull market in the equities to continue. However, the volatility will also continue, so use extreme caution. How can that be? You know that it's rolled over. You know that it technically wants to contract and have a washout, and it's healthy, and they're not going to let it. So that's why you're going to see this whipsaw back and forth between bearish and incredible bullish responses. Well, today we had a huge reversal. It was the opposite. The markets were up going into the release of the minutes, a couple 100 points on the Dow, for example, and an immediate reversal. The more he talked, the more the markets dropped. So that doesn't bode well for what comes in the coming days.
No, and I think there's a good argument to be made that the big reversal back up that we saw in the Dow and the NASDAQ and the S&P, a lot of that is going to be stop-loss positions. We're looking at turning around at about a 50% reversal of all the gains last year. So, Robert, what you were just talking about with all the great gains, it's like playing poker, right? It takes you all night to build up a stack and only one hand to lose it. We gave up half of the 2021 gains in the equities market just in the matter of a couple weeks. And we come into that 50% retracement. We come down to the previous lows, which date back to around October of last year, beginning of October. Of course, you're going to have buy orders sitting there just below that price to push the price back up across the market. So I think there's some trading explanation in here as to why we saw a bounce, but it does not change, to your point, Tori, it does not change the consensus of the market going forward, and that's the expectation, which was reiterated today in the Fed speech, in Powell's speech, that things are going to tighten. The free money is very likely not going to be quite as free for people like you and me if they start raising interest rates. Now, it's probably still going to be free to the banks and free to themselves, but it's going to start costing us more.
Oh, for sure. And that's part of a debt-driven economy. Their mission is to prop up the equities markets and to keep the credit markets flowing. They need America borrowing. They need the credit markets to remain fully open, whether it's from banks to borrowers or from mortgage lenders to home buyers, whatever, which those numbers came out and put a little downward pressure on gold as well today because the home buying was actually very positive for 2021, but we all knew that. In the meantime, we're flirting, you guys, with $30 trillion in U.S. national debt. We're at $29.9 trillion. That blows my mind since we've been doing this show that we've seen it climb just that much. So, yeah, they're talking about the rate hikes, but they know they can't slow down the credit markets. He's already said it again today. So they'll do a little bit at a time. But the whole time he kept talking, guess what started to get away from him? Treasury yields. They don't control the real interest rate in the markets. It's the bond market. It's the treasury market that controls the interest rate. And it went up to 1.83%, climbing. The more he talked, the more the treasury yield started to increase on that 10-year treasury. So the markets do not like what he's saying, just even talking about slowing the easy money down. And if they keep up with the easy money, guess what? The metals prices are going to continue to climb. Inflation will continue to climb over our lifetime. It's not about what it does in 1 month. And his quote, no inflation reversal in the near term, and the rise in prices could actually accelerate. So even with the rate hikes, they're admitting that there's no inflation reversal in the near term expected. And in fact, it's likely to accelerate. And they're begging for some supply side relief. Well, where are they going to get it? Because they say that the job or the labor market is so high and so strong that there's more jobs available than there are unemployed people in the United States. Now think about that. What does that do to wages, Miles?
Oh, you just put a quarter in me because we were talking about this before we started recording. You know, it's funny. Every month, I think we all have that one thing that Powell says that just makes us mad. And sometimes it's the same, sometimes it's different. So here's my angry Jay Powell moment for this month. Discussing inflation, he opens with, inflation remains well above our longer-term goal of 2%. Thanks, we know. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation, obviously. Thanks. Then he goes into talking about the things we already know, bottlenecks and supply constraints, drivers of inflation caused by the pandemic. Yeah, they printed a lot of money to try to glaze over that. Price increases have started to spread to a broader range of goods and services. Yes, that's how inflation works. Inflation works its way through the entire system. But here's the part that at least got under my skin. So this is a quote. Wages have also risen briskly. Okay, I'll buy that, right? I mean, doesn't that make sense? If inflation goes up, cost of living goes up, therefore employers then have to raise wages so that their employees can deal with those cost of living increases.
Well, and they're having to charge more for the cost of goods sold.
But that's not the end of the quote. That would have been a great place to end that quote. But he kept going and said, and we are attentive to the risks that persistent real wage growth in excess of productivity could put upwards pressure on inflation. I don't know about anybody else, but that makes me angry because last time I checked, wage increases are a result of inflation, not a cause of it.
That's right. It's a delayed response.
Yeah, just like the cost of goods going up. It's unfortunate one's not driving It's the other driving the one.
And I don't understand how they can put that back on the American worker and the American taxpayer and say that your increased wage is what's causing inflation because it's not in excess of the productivity you could be doing. It just bothers me. I feel like I'm getting gaslighted.
And you are, because just focusing on this labor market issue, and then we'll move on, but the labor market, he says, can absorb the higher rates because it's strong. 2 weeks ago, he's talking about, 2 weeks ago, we want participation to come back, but it's been quite slow, is his quote from 2 weeks ago.
Wasn't it the worst December seasonal employment numbers in like decades?
Yeah, and workers quit their jobs at a record rate in November, while the job openings stayed close to the highest ever levels. So you actually had a dumping of jobs in November and December, and he's saying that they want labor participation to come back, but it's been quite slow. And the next part of that quote is, it probably will take a long expansion to draw people back into the labor market. And then today you hear him bragging about the strength of the labor market and that unemployment's below 4%. It boggles the mind, but when politically appropriate, we all know that people in Washington can speak out of both sides of their mouth.
That does it for Golden Rule Radio this week. You can always call us to talk with us about your portfolio at 800-525-9556. Find us on Facebook, McIlvaney Financial. Follow us on Twitter at ICA Gold. Click the subscribe button below to subscribe to our channel and our website, McIlvaney.com. Thanks for listening. Have a great week.